everything you need to know about mortgages with Lori Lalonde on The Wealthy Acre. I am always looking for incredible professionals to work with and refer clients to. And when I met Lori, I instantly thought we were a great partnership. She's an incredible mortgage broker, and we hit it off right away. She recently moved to the Creston Valley with her 2 rescue dogs and is absolutely loving the small town vibe. This lady has over 25 years of invaluable mortgage experience, and lucky for us, now she brings her experience and work ethic to the Kootenays. And I am so thrilled to have her here on our podcast to introduce her to our listeners and my clients as well. She absolutely shines in every step of the mortgage process. If you're a first-time home buyer, financing your home, investment, second home, whatever it might be, she's your gal. A massive benefit is her relationship with multiple lenders, private lenders, and a creative approach if required. Now, Lori, thank you so much for joining us here on The Wealthy Acre. Let's get started. Please tell us a little bit about yourself. I know you have 2 amazing Mexican dogs, which speak Spanish. I hear they're bilingual, but tell us a little bit about yourself.
Thank you so much for having me on here. Yes, I have 2 little rescues from Mexico, and I got the first dog during COVID and then needed a friend for Millie. So I have Millie and Milo, and I call them M&M.
That is adorable.
Yeah, they're so sweet. And yes, I moved to Creston just about a year ago, and it's been lovely. The community here is so amazing. I moved here because my sister lives here and I wanted to be closer to her. And it's just been wonderful. The slower pace compared to the Okanagan solitude, I just feel like it's very peaceful here. And the great thing is I went from a condo into a house. So now my dogs have a fenced backyard, which is just wonderful.
The things that we do for our animals, it's incredible. Right? And you started like your career, I'm almost aging you, which I'm sorry, like 25 years ago. And how did you get into mortgages? Because you were traveling everywhere, all over BC. You've done tons of work around BC. And right. Tell us your story on why and how and why you're still doing mortgages.
After I finished university, a friend of mine said, well, why don't you apply at the TD Bank and see if you can get a job? And I did. And I worked at the branch level for quite some time. I did a little bit of mortgages, but I was opening accounts, GICs, car loans and consolidation loans, etc. TD mortgage sales representatives that worked in that area, they would bring their clients into the branch and I would sign the mortgage documents for those TD mortgage representatives. And it interested me. So I applied for a job as a TD mortgage specialist and I got it. And I worked there for probably about 5 years. And then I just realized so many of my clients weren't fitting in that box. And so I went and got licensed with the province of BC. And now I have access to about 40 lenders and banks, but we use maybe 3, 4, 5 of them. And I love helping people. I love helping them see their dreams come true.
I love that. And that is so amazing. You went into being your own independent mortgage broker instead of a mortgage specialist with one bank to really cater to a lot more people. You feel like when they were going to just one bank, maybe they weren't getting the service or they didn't have the options that they could potentially with going and shopping around like you would do for them. So speaking of which, what is the benefit of going to someone like yourself, a mortgage broker, as opposed to a bank? Maybe I bank with RBC or TD for a long time. What's the benefit of going to you specifically?
The feedback I get from my clients, the most important thing is the schedule. People work 8 to 4, 9 to 5, 10 to 6. Kids, they can't just take time off to go to the bank. So with a mortgage broker, we do work nights and weekends. We work whenever our clients need us. So accessibility is the most important answer to that. I can pull their credit report once and shop all the financial institutions to find perhaps a better rate or terms and conditions attached to the mortgage, and they don't have to leave their home. It really is a win-win.
And you can place that client to what suits them, what they require. If they're self-employed, maybe this lending institution or this bank or might be better suited for them than the credit union or vice versa. Yeah. And I find I really, really like that. And you work realtor hours, which is always nice when we have questions.
Yep.
Because offers, I mean, we write offers at all different times. Like it could be 10 p.m. and we're still dealing with offers. And if it's like, if I need access to a mortgage broker, I don't have access to the bank. So if somebody's at the bank level and they're like, okay, we got pre-approved at the bank, I can't reach them when I need them so desperately. When it's like, time is of the essence. We're like at the nitty gritty, getting this deal done, and we don't have answers from a mortgage broker. So I love that you're available, and that is massively important. So thank you for that.
Well, and when I worked at the TD branch, at the end of the day, I want to go home. I'm exhausted, but yet I still have to look at all the phone calls and take the messages. Well, 99% of the time I said, oh, I'll deal with it tomorrow or the next day, because my plate was so full. And most people at the branch level, their plates are full. So as an independent mortgage broker, we just work hard. We will be available at any time.
And it's a focused approach. You're not getting pulled in all these different directions. You are focusing on mortgages. That's what you do. That's what you specialize and that's what you shine in. And is there a benefit of going to the bank for someone maybe in particular?
Not that I'm aware of. Unfortunately, I hate to say that. Maybe if someone has that long history and standing relationship with someone at the credit union, perhaps that's their comfort level. But so many people have a variety of products with a variety of financial institutions. So I'm not really sure of a benefit. I hate to say that, because I'm sure there is one, but I'm just not aware of what the benefit would be.
So big topic right now, interest rates. We're seeing interest rate coming down. Buyers are starting to regain some confidence in the market. But because the interest rates are coming down, what does that mean for our economy? So it's great, but...
Yeah, so when rates come down, it's typically because our economy is not at the peak, I guess I could say. With rates coming down, it's good. It hopefully will fuel our economy again. So, because when someone buys a property, it's a dominoes effect on who's getting help. So you're now working with a local lawyer or notary, insurance companies, furniture stores. There's a variety of other components to the rates coming down. So it's good for our economy, but it takes this to kind of kickstart our economy again as well.
Now, with the tariffs coming in and the political scene, kind of in your opinion, where do you think rates potentially, how low are we going to be able to see them? Do you think we're going to see COVID rates? I mean, it's uncertain times now. It was uncertain times during COVID. Obviously, our economy was suffering during that time as well. There was a lot of good and bad. What do you foresee? Where's it all going in your crystal ball?
In my crystal ball, the answer probably changes day to day. It depends what I'm watching on the news, what newspaper I'm reading, what economist I'm listening to. I think they're still going to come down. From about this time last year, we're down about 2%, which is great. I think they'll come down a bit more. Will we go back to those rates during COVID? I'm not sure. I hope so for buyers, but I'm not sure.
No way to tell, that's for sure. So in terms of interest rates, who determines the interest rates? I know there's like announcements from Bank of Canada. There's all these different things. We're getting inundated with information, but we don't really have it straight. So who determines interest rates? How are they managed? Who decides on that?
Right. So fixed rate mortgages are linked to the bond market. And so depending, when people are investing millions and millions of dollars in the market, that's how they determine the fixed rates. And so variable rate mortgages are linked to the Bank of Canada. And the Bank of Canada, they make an announcement several times throughout the year, and they'll decide based on our economy and rate of inflation if they're going to keep the Bank of Canada rate as it is, increase it, decrease it. So it's the Bank of Canada that will decide. And that is linked with home equity line of credits and variable rate mortgages. There's a lot of good pros about a fixed rate if you can get in at a really good interest rate. People know what their mortgage payments are going to be each time that payment is made for the term of the mortgage. So it kind of gives people a peace of mind. It's a great product for people who work jobs where they're not going to get much overtime. They don't work a second job. They know exactly how much money they're going to bring home each month. Whereas a variable rate mortgage can fluctuate and people need to be prepared for that.
Can be a
And
little stressful. I mean, with a
very
variable,
much so.
right? Like you don't know what's going to happen. Bank of Canada comes in and rolls out rate increases, and all of a sudden your mortgage payments are more.
Right. Yeah. And with these two products, with the fixed rate mortgage, and this is why it's really important to have the conversation with my clients, because you want to get an idea of what their plan is for the next 5 years. Because if you want to break a fixed rate mortgage, the penalty is very, very high. And if you break a variable rate mortgage, it's a 3-month interest penalty. The terms and conditions vary substantially, although you can port a fixed rate mortgage, but we never know if that's a good idea unless we know what the rate of the day is at that time and depending on the term. So first time home buyers typically go with a fixed rate if it's a good rate, just so they've got that peace of mind.
And speaking of rates, I mean, there's different terminology. There is benchmark and prime. It's very confusing when we're getting, again, all this information. What does each one of those mean? What are the different types of rates?
Yeah, so the benchmark is just, it's an overnight rate. It's a word that determines the overnight lending rate. And that's what we will qualify people on with the variable rate mortgage. If you've ever noticed, TD Bank has their benchmark 0.15 higher than all the other financial institutions because the bank can set it at whatever they want, depending on how much money they're lending.
So that wouldn't be posted rate, would it?
Posted rates are linked to fixed rate mortgages. And then when we talk about variable rate mortgages, we say the prime rate, because right now the prime rate is 5.20, but that can adjust when the Bank of Canada makes an announcement. So we always say prime minus, because if I get you a variable rate mortgage for a 5-year term, that prime rate could adjust up or down, or it could stay the same. We don't know. So we always make reference to prime minus because the bank will discount that rate.
And that discount's always the same. It's just the prime will change. Is that correct?
Exactly. Yeah.
So when Googling interest rates, what your mortgage is going to be, there is usually the bank offers a certain rate and it's like amazing. You call it a teaser rate. Can you tell us a little bit about that, the red flags and what to watch for?
Yeah, I understand people want to get the best interest rate on the market, and that's my job, is to get the best rate based on their objective. When you go online, the lenders will throw out the lowest rate possible to get people intrigued and apply for it, but it doesn't disclose the terms and the conditions. So an example would be some big banks were offering incredibly low interest rate, but the fine print was it was low for the first 9 months, and then it jumped up substantially for the remaining of the term. And that's where what we call a teaser rate. It gets you kind of in the front door, and then at the end of the day, it's not a better deal because of the way they show the rate on the remaining 4 years and 3 months.
Yeah, so it's a surprise that no one wants.
Well, and not only that, but when looking for rates or even going online to see if you qualify for a mortgage, the online system doesn't factor in the stress test that we have in Canada. Stress test is what we qualify you at 2% higher than what the rate you're given. And it's just for qualifying purposes. And so it's misleading to people because they think, oh, I can afford to buy a $400,000 house. But that's really not the case because they didn't qualify on the higher interest rate. So it's kind of a guide, but it's not a very good guide to go online and check rates or see if you can qualify for the mortgage.
That's a really good point. So let's talk about the stress test. Explain what that is and why maybe it has been a benefit because when it initially started, hindsight being 2020.
Right. Well, when the United States got in trouble quite a few years ago, Canada felt that they had to tighten up as well. And overall, I'm glad we did because at that time, you could put 0% down and a 40-year amortization. Everybody was getting mortgages. I mean, all of us were doing mortgages in our sleep. And then the market shifted and quite a few of my clients ended up with negative net worth because the property values had dropped. But when you put zero down and amortize over 40 years, it's going to take years and years before you build equity. So the government said, we're going to put a stress test in place and we have to qualify people at 2% higher just to make sure that if rates do go up or down, that people can still afford because we've qualified at 2% higher. Overall, it's been a good tool. A couple years ago when the fixed rate mortgages were 6.5%, well, we're qualifying at 8.5%. And we can't qualify people. So the housing market really slowed down. Now we're seeing it come back again because rates are dropping.
In hindsight, it made sense why they put that into place. Because when we were having the 2%, 3% or less rates, you add another 2%, you're looking at 4%. It gives buyers a little bit of a buffer saying, okay, you're going to get that lower rate. However, we have to qualify you at a higher rate. So it really made sense that they did that. It gave people a little bit of a buffer to say, okay, I can afford that. Are you seeing a lot more activity due to the mortgage rates coming down? Buyers, again, regaining some confidence in the market. What are you seeing right now with buyers in the real estate market?
Yeah, I'm quite surprised actually, because typically January and February are slower months. We kind of see the activity I'm seeing now hit in March. But we're seeing it early, which is a good sign. And that is because of the rates are coming down. Plus, we've recently had quite a few changes to mortgage policies, which is making it a little bit easier, I could say, for people to get into the market. I'm not busy by any means, but a lot more activity in 2025 right now than it was in 2024.
You still have clients a little bit everywhere. So you're seeing those markets, which is interesting. The coast you mentioned, are they doing any multiple offers right now? Like how's that happening?
Sure are.
Amazing.
They are. I know. I'm surprised. My clients, a few of them unfortunately have missed out. And one place just it was at 1.5 and it went at 1.8. So 300,000 over asking. And so we are seeing multiple offers. We're seeing a few in the Okanagan, not a lot, but we are seeing more and more activity and more multiple offers. So
awesome. It's nice to hear about the different markets. So I'm glad that you have your fingers in all those markets and are able to update us on that. And what about mortgage renewals? So I know my mortgage is coming due at the end of the year. Of course, my interest rate was I think less than 2%. I'm embarrassed to say that right now, but of course it's going to be a lot higher. What are you finding amongst your clients? Are people managing or are they struggling now that the interest rates are different and mortgages are coming up for renewal?
It's all over the map. People that got their mortgage 5 years ago, their payments are going to double. And in that 5 years, have they taken on any extra credit card debt? Have they taken a car loan out? Because sometimes you think, oh, that payment is never going to change. And unfortunately, it will. So I have advised one particular client to actually sell their property only because I would rather see them walk away with some equity than get into a position where they foreclose. So it really depends on, it's a case by case. Some clients have to stay with their current financial institution because they won't requalify if we move them, and which can be good. But I would encourage people to negotiate the interest rate if they feel they have to stay with their existing lender.
So you can negotiate, because I know you get a letter about 4 to 6 months before your renewal is due, and they give you a rate. It's usually not the best rate because I've seen better rates out there, but you don't think that you can negotiate.
Exactly. I've had so many clients just sign and say, oh, the bank must know best, or they've been my bank for 20 years, so I trust them. And that's not the case. Talk to me and let me know. Maybe I can help, maybe I can't, but I could always guide you and what to say to your financial institution and say, I spoke with a mortgage broker and they can offer me this. And all of a sudden you see the bank sharpen their pencil.
Nice.
Yeah.
So that's great to know. So definitely get a second opinion, talk to you to see if there's an opportunity there, and save some money. Like any percentage could save so much money in the mortgage. And what are the people that are able to, what are they doing? Are they getting a second job? Are they getting family help? What are they doing? Maybe selling that second car. How are they managing, the people that are managing?
Yeah, it's tough. It's really tough. Some people are taking other jobs. We're seeing more people rent out a room, not a basement suite, but rent out a room or rent it out to a student. Some are getting up to $1,000 a month. Many people are making sacrifices to their lifestyle that they have.
I love that they're getting creative to hold on to their home. And if you
Yes.
absolutely can, do whatever it takes. I know we mentioned the stress test and it's 2% above what somebody's interest rate is going to be. But now there were some changes with the stress test on renewals. So let's touch on that a little bit.
Yes, in fact, I just received an email about 3 minutes before we got on here, and another lender has jumped on board. So they're able to renew your mortgage, move it on the contract rate. So not using the stress test. Everything has to stay the same. You can borrow up to $3,000 to help with the legal fee, but you will be able to renew at a contract rate. So not using the stress test, which is going to help out a lot of people.
Absolutely. And this is not refinancing, this is renewal. Can you talk us
Renewal.
through the difference?
Yeah, refinance is if you want to take out some equity. Maybe you want to pay off some credit card debt or pay out a car loan. If you have the equity, we can take the mortgage amount that you owe and add onto your mortgage up to 80% loan to value. And as long as you qualify, you can take out any extra equity, and that's a refinance. A renewal, you're renewing the mortgage the way it is. We're not making any changes to it. We're going to keep everything the way it is. The amortization, everything. Yeah. Yeah.
Awesome. Thank you for that. So my favorite topic, first-time home buyers. I think it's my mission in life that everybody should own a home. Everybody should have the right to own a property. So first-time home buyers, I know they're my favorite type of clients. I love working with first-time home buyers, and I know you do as well.
Yeah.
What are some of the advantages of being a first-time home buyer? Let's give people some hope that they can jump in and buy the first place.
Yes. So quite a few benefits. So as a first-time home buyer, if they purchase below $835,000, they don't have to pay property transfer tax, which is huge. Property transfer tax is a tax that you are exempt from the first time you buy your home. If you buy your second home, then you have to pay this tax.
It's actually a significant amount. If it's 1% on the first 200,000 and 2% on the balance, and it adds up. It's amazing, and it's only in British Columbia. I don't think other provinces. I know Alberta doesn't have it, and I don't know about other provinces, but it is a British Columbia tax, and it's incredible. So as a first-time homebuyer, you are saving thousands of dollars on your purchase. What are some other benefits?
You can use up to $60,000 of your RSP per person, up to $60,000, and you have 15 years to pay it back, which is huge.
And it's tax-free.
Mm-hmm. Tax-free. Yep.
Wow, that's amazing.
Yep.
If you have employee matching or whatever it is, you've been saving your RSPs, you can take it out tax-free up to $60,000 per person and put it towards your down payment.
Absolutely huge. And as long as it's owner occupied, you have to live in the property. So lots of benefits for first-time home buyers.
I love it. So there's money available. There is definitely a little tax exemption. There's definitely advantages there. So isn't there a buyer's savings as well? Is it like the RSP or different? How does that work?
It is. It's very similar to the RSP. So it's a first-time home buyers program. And again, that one's very new as well. I did one for a client, and it really wasn't beneficial. And I'd have to go back in and see why, but it is available. It is. I have to get some more information on that.
I almost feel like you might as well just put it in your RSPs. You can still take it out and it's tax free as long as you pay it back within the 15 years. For me, I didn't feel like it was like a wow factor to me. So, but it's awesome. Any money that you can save it, wherever you put it, just save it as a buyer. But definitely, there are options for buyers, which I love as well.
Yes. Yeah.
So in general, for buyers, not necessarily first-time home buyers, where do you usually see that people bring their down payment from? I know we mentioned RSPs, that's an option. Where else do people get their down payment from?
It's really changed over the years. And as the housing prices have increased, a lot of people are getting an early inheritance. Grandma and grandpa or mom and dad are helping their kids out. We're seeing a family member come in and lend money to help towards the down payment. It's really shifted. You know, when you had $20,000 in savings, it was easy to buy a place. But that 20,000, depending on what pocket of BC you're living in, isn't a lot of money to buy a property. So yeah, the bank of mom and dad are really stepping up.
And going back to first time home buyers, I don't know if we touched on it, your down payment could be at 5% if you're
Yes.
buying up
Yep.
to $500,000.
5%.
So that's
Yeah.
also something that maybe is affordable to lend some money from your parents or your family, or getting an early inheritance. So it's not like a
Yeah.
huge lump sum of money. It is quite
Yeah.
reasonable.
If the clients have really good credit and the file is solid, and say maybe they're short $10,000 of getting everything together, we can borrow from a line of credit. We just have to disclose it on the application, and it has to debt service. So that is an option as well.
And that's part of the creative approach that you can take, and
Yeah.
saying, okay, we're lacking a little bit of a down payment. Let's see where else we can grab it from.
Yeah. Yeah.
That
Because most financial institutions, not only do they want to see the down payment bank statements, they want to see the closing costs. And so I always say, well, this is a first time home buyer, so we don't have to show property transfer tax, but we have to make sure that clients have money for a legal fee and their homeowner's insurance. So that could be up to $3,000.
And that's good buffer to have for sure for closing costs. So
Yeah.
speaking of which, I really encourage people to get pre-approved before we go shopping. I want people to
Absolutely.
know how much we have to spend, how much money we have to work with before we go and look at properties. And then we're more confident to move forward. So what do you do to pre-qualify a buyer before we go shopping?
Yes. Once the application is completed, I'll process it immediately, but then I'll also ask for all the documents up front. I don't want any surprises. So I pull the credit right away, and I want to make sure that the income that they put on the application matches their pay stub or last year's taxes. Because some people will say, I made $100,000 last year, but they had a lot of overtime. But if you've only been with that employer for 6 months, I can't use, if it's not guaranteed hours, I can't use that overtime as income unless you've been with your employer for 2 years. So we really need to see the documents up front. I pretty much do a full approval right from the get-go. I want everything up front, and that way people know this is the maximum you can buy for, and then work your way backwards. So,
I love that. Yeah.
and looking at someone's credit is really important, because there is a lot of identity theft out there, and some people's credit is tarnished and they're not even aware of it. So it's nice for me to go in and look at it, because your credit report is really how we gauge interest rates and can you even get a mortgage. So it's really important to keep up to date with your credit report.
And I love that there's no surprises. And as a real estate professional, for me, it's really important. Then I know, and I can put offers in with confidence. This buyer's been
Yes.
pre-approved to the max. They have their job
Yep.
letter and they have their debt ratio. We know what their credit score is. We know what their income is. Well, I don't, you do, but
Yeah.
we have all of this, and we come in with confidence, and there
Yes.
is nothing like it. And a seller loves to see an offer with a pre-qualified buyer. They're ready to go. And we know that as long as the inspection is good, the appraisal is good, we don't have issues. And
Yeah.
that is the way to do it. And everybody is
Yeah.
happy. And that's how smooth deals get done.
It just saves a lot of time for everybody. It's just one of the easiest things to do is just get your ducks in a row.
The ducks need to be in a row.
Yeah.
And and creative lending in a way. So there's different types of lenders. There is A, B, Z. I know there's private lending. There's all these different types of lenders. Let's talk about that, because we always assume that the bank's going to loan or just the credit union. So what are some of our other options?
Yeah, so outside of the big banks and some of the monoline lenders and the local credit unions, you have to fit pretty nice and tight within their box, which is, and a lot of people do. Most people do, not a problem. But maybe there's some challenges that the client had in the last year or two. Maybe they went through a separation. Maybe they were off work for a long period of time due to health reasons. They got behind in some of their bills. And so they don't fit the traditional AAA financing world. So we have to put them into a B lender, what we call them. And so we get to extend the ratios. They look at things a little bit differently than the traditional way. The interest rate might be a little bit higher, but with maybe a little bit larger down payment, they look at it. They'll look at the file and determine if they can help out. So that's a B lender. And then we have a private financing. I do a lot of private mortgages, and that's for people who private lenders are really looking at the equity in your home or the size of your down payment on a purchase. The stronger the security, the better. They don't ask a lot of questions. They're strictly using your home as security. The interest rates are quite a bit higher. And I always encourage people, it's really a short-term fix. It's not a product that you want to stay in for long term. We always want to find the best exit strategy for you. And a lot of the times it could be someone wants to buy this place so bad and they're going to get an inheritance. And I've seen a copy of the will and go, yeah, we're comfortable with this. And so we have to get them a private mortgage for 6 months or so. So there's a variety of reasons. The biggest one with using a private mortgage is to pay out Canada Revenue Agency. If anyone owes CRA money, the big banks don't, if it's over $2,000, they won't allow you to pay out CRA to take equity out. So then we go to a private lender. And so we have really creative ways with private lending, but it is higher interest rates and fees are applied. So the private lender will dictate how much it's going to cost and that they pay the mortgage broker out of those fees. Mm-hmm. Whereas traditional financing, we don't charge fees. The bank or credit union pays us. So clients don't pay for our services on the A side.
So basically you want to go with a triple A bank, you want to make it really streamlined, very easy, but if you can't, there are other options. Short term, you can get private lending, and then you can move into the triple A, reduce your interest rate and pay less fees and so forth. So that's awesome that there are options for people, again, to still get into their home and find creative approaches to do that. It might be a two-step process, but here we are, we can do that. So what if somebody wanted to take equity out of their home? They wanted to refinance their property. They've been living there for a period of time. They have some equity. They're like, I want to renovate or I want to buy another property. What are some of the options? I believe it's 80% of the equity they can take out. What are some changes? What's kind of happening in that field?
You can refinance your home typically to 80% if you're wanting to take equity out, maybe buy a rental property. But now there is a new program where you can finance up to 90% and borrow up to $80,000 to build a suite or a carriage house on your property or build a suite in your home, which is very, very new. And that's going to help a lot of people. There's a lot of terms and conditions attached to that. And if someone's going through a marital breakup, divorce, we can refinance up to 95%. That's the only time you can go up to 95%. And that means we're taking someone off mortgage and title. It's a very good opportunity for people to, not only are they going through a divorce, but that one person doesn't have to sell their house. It makes it a lot easier for so many people.
Yeah, they can buy the other person out and move on with their lives. That's amazing.
Yeah.
And what are other ways to maybe tap into that equity, like a home line of credit? Tell us a little bit more about that. Somebody maybe wants to do a renovation and they want a little bit more money they've been paying into their equity. What are some of their options there?
Home equity line of credit is a really good product. The majority of the time, it's if people have a house free and clear, some people might have a home equity line of credit and it just sits there. If you don't use it, you're not charged anything. If it's a $200,000 limit, if you utilize a portion of that, you just pay interest on that portion. And you can use that to put a new furnace in, buy a rental property, renovations, whichever. You can also get that product, what we call in second position. So they still would register it against your home, but behind your first mortgage. And it's like an emergency fund because a lot of people have unsecured lines of credits, but the interest rate's higher. And of course, your credit cards are at 20%. So if you do need a new hot water tank, you're not going to pay so much in interest. You can use that home equity line of credit. It's a very, very good product.
I love it. I think it is a great product. And like you mentioned, it's registered against the home. So it is on title. It is there. So of course, when you sell your home, that has to be cleared. So that is
Exactly.
something
Yeah.
to consider as well. I have a program. Maybe you can kind of touch on that for one of our properties. It's Scotia Step. Can you talk a little bit about that? It's a little bit different than
Home equity line of credit. Yeah.
it's a little bit different than that, but maybe you can just touch on that one. And I believe there's another bank that may have something similar. How does that work?
So with the STEP program at Scotia, another great product is each time you pay into it, you are building a savings account. And so you can always, for lack of a better term, you can access that down the road if need be. So you're paying it down, but you do have access to that at any time.
Every time you put money towards your mortgage, you're paying down your principal. That amount goes into this savings account, which is
Yep.
available to you at an interest rate. And it's
Yep.
usually lower than any credit cards or anything like that. So again, just to have a good savings account, a little emergency fund or anything, just to have
Yeah.
that money available to you.
Very good product. Yes.
I got to tap into that. I got to see how much I have in there. So it used to be that to purchase a home over $1 million, you had to have more than 20% down. Right now, there has been changes that you can purchase your home up to $1.5 million with less than 20% down. What are some of the qualifications for that? Is the bank looking at different things? Of course, you're creating more debt as a purchaser.
Yes, that policy is really designed for Vancouver, Toronto, where you can't really find anything under $1 million. So they've increased this, and to qualify for it, you have to be rock solid. The client has stellar credit, employment, really good savings. Everything is perfect on the file. And so yes, you can put less down payment, but CMHC will charge an insurance premium on that, and they will absorb that into the mortgage. So someone doesn't have to pay for it, but the premium is substantial. Once you buy that property, if there's also a basement suite in it, we can use that basement suite to offset some of that mortgage payment. Your mortgage payments on $1 million plus, you're probably looking at roughly $5,000 a month, I would say. And then if there's a suite, though, we can offset that with that mortgage payment. So it's a good product because it is getting people into the market in certain pockets of Canada. But yes, you're carrying a lot of good debt. I mean, it's your mortgage, so it's good, but you are absorbing that CMHC fee, which could be in the tune of $30,000-$40,000.
That is a lot of money for that. But again, get into the market. Get into the market. If
100%.
that's where you're going to be. If you have a secondary suite, that will help with
Yep.
the mortgage payments,
Yep.
of course. And there's definitely ways to do that. So I love that.
I encourage anyone to do whatever you can to get into the housing market.
Absolutely.
Yeah.
The secondary suite incentive program is a new program as well. And I'm just really curious because, of course, you're now loaning up to 50% of what you spent on renovations. So that is forgivable every year for 5 years. So, for example, if it's $40,000 forgivable loan, $8,000 is forgived every single year. Now you've built a secondary suite, you have to comply with lower rental. How does it work if somebody wanted to refinance that? Now they've created value in their home to create that suite. Are they able to, knowing that you have this forgivable loan, but is it?
Depending on where you are in the loan. And I do have to say this is such a new product. I'm not even up to date with all of the policies. That's how new this is. From what I understand, though, it's going to take quite a bit of time to build up that equity, and just not 100% at this time because, again, this product is so new to all of us that we haven't got to that point yet because the product was just released. So we're not there yet.
And we'll have you on again once you do. I was always really curious because now you're adding value to your home. But of course, you have to consider the fact that you are this loan that's technically forgivable, but it's only forgivable if you comply with the regulations and the annual filings and have a renter in there and all these different things. If you don't comply with that, now that loan is no longer forgivable. So I'm curious to see
Right.
how the bank is going to treat that. And because there's so many, so there's a risk because it's uncertain. So I'd be really curious about that if we can look into that.
I will.
All right. And now, just before you leave, I would love to get some tips from you. Do you have tips on how to pay down your mortgage faster?
Yes. Typically, all financial institutions will allow you to pay 10, 15, 20% an annual lump sum payment in a calendar year. A lot of people, when we have a discussion about making their mortgage payment, they go, oh, well, I'll just stick with monthly because that's probably how they paid their rent all these years, or their car payment has been monthly. So I would encourage people to go bi-weekly, but if they could go bi-weekly accelerated, it is a huge savings. So typically if someone gets a 5-year mortgage and a 30-year amortization, when your mortgage is up for renewal in 5 years, because you've done the accelerated payment structure, you've already shortened your mortgage term close to 5 years. It's huge, and it's maybe an extra $20, $25 a month. So it's not a lot of money, but it's amazing how much that money will go right towards and reducing what you owe. So I would really encourage to go bi-weekly accelerated if people can.
Wow. So bi-weekly, so every 2 weeks, you can literally bring down your mortgage 5 years. That's incredible. And you can also up your monthly payments, and you can do lump sum. Is that correct?
Correct. You can do all of those things. And I always say to people, $25 doesn't really sound like much money, but if you put that away every couple of weeks and all of a sudden you do a $600 lump sum payment, that's a lot of money going towards your mortgage. It really is. Yeah. So instead of maybe going for coffee on a daily basis, cut it back once or twice and use that money to go towards your mortgage.
Oh, absolutely. Or you get a bonus at work or something like this, or nobody's getting Christmas presents. We're going to pay down the mortgage. I think that's amazing. If someone has bad credit and they want to work at improving their credit, what are some of the advice you can give them?
Bad credit, again, identity theft happens and people aren't aware that they've now got bruised credit. Maybe there is a bankruptcy. We actually have lenders, B lenders, who will work with past bankruptcies to help out, but let's pull the credit, find out what the issue is, and then how to rebuild it. So maybe it's going to be, if you've had some credit card challenges in the past, maybe getting a secured credit card like Capital One or Home Trust, where you put money down and then your credit limit is secured, and that way use it, pay it, and that really helps increase your credit score, and it shows the lenders your history. So typically when people are applying for a mortgage, we want to see a minimum of 2 trade lines, we call them. So that might be a credit card and a student loan even, and we want to see a repayment history of 24 months. We want to see how you've made your payments. And if you've had some challenges in the past, it would reflect on your credit. So talk to your mortgage broker, talk to me on ways on how we can increase your credit score and get you back up and running so you get these A rates and whatnot.
You had a client and that client either had debt or a larger down payment. What would you prefer?
Pay down the debt.
Yeah.
The reason I say that is it could make a difference on how much they want to purchase their home for. So if you have a credit card, you owe $10,000 and your minimum payment is $50 a month. When people are applying for a mortgage, we have to say that there's 3% of the outstanding balance is what you owe each month. So in $10,000, that payment would be $300. Now your income has to support a $300 a month payment, although your payment's only $50. So that might not get you where you need to be for buying a property, but pay down your debt. Again, talk to me because we can get creative on how to do things. And so I would say pay down your debt because the interest rates on a credit card are very high. Maybe we look at applying for a consolidation loan with your local financial institution, because if you have a low loan payment, because that's a fixed portion, we just get to use that monthly payment to debt service. Whereas a line of credit, we can't. So pay down debt as much as you can. And a lot of people use their credit cards. Okay, you've got to pay this $10,000 down. I go, yep, we do it every month. They live off their credit cards to get the points, and then they can verify that, yep, we've paid it off at the end of the month. So that's great. But if you're continuously having large amounts of debt month after month, you're really just paying a lot of interest.
So pay down your
Hmm.
debts, and even if you have a
Yeah.
little bit of a smaller down payment, that's okay. We can figure that out, but pay down your debts. And of course, talk to you first, get your
Yes.
second opinion, even if it's for renewals, refinancing, first time home buyers, we're going to talk to Lori. So Lori,
Yeah.
what is the best way to reach you?
Thank you. Yeah, my number is 604-329-9000. And I'm all over social media. I do some advertising in the local newspaper here in Creston. So reach out to me by email, phone, text. I love to talk to you and help any way I can. I'm very honest and telling people, based on your file and your circumstances, it's best for you to stay with your financial institution and let's revisit this 12 months or 24 months down the road. Or no, you're really not getting a good deal from where you are. Let's pull you over here and do this. So I'm very honest with my clients.
I love that. And when I speak to clients and when I'm sending them your way, I do tell them, I'm like, tell Lori everything. She will figure it out. She will put it together in a nice package and present it to the lender that needs to be presented to. And that's the beautiful thing, right? Like, tell you everything, be an open book, be
Yeah,
honest, because some people are maybe ashamed of some of the debt that they have. It will come out.
it will. It will. Yeah, it will. And I make no judgment. I want to help. And I need all the facts up front so I can decide how to package it and what lender to send it to, because again, each lender has different policies.
Like if they mention that they have maybe child credit or they have other maybe disability or whatever it is. But again, it's like talk to you about absolutely everything. You're going to figure out, you're going to put that together in a beautiful package
Yeah.
with a nice little bow and you're going to hand it to the lender and it's going to be beautiful. So Lori,
Yes.
I
Yeah.
just love having you on here and you are a wealth of information. Thank you so, so, so very much. And I'm going to make sure I put your contact information below as well so people know how to find you. And I highly, highly suggest to get at least consultation with you to see what you can offer them. Thanks so much, Lori,
Yeah.
for being here. I really appreciate it. And thank you
Wonderful.
for your time.
Thank you so much, Deanna. Take care.
It is so important to have professionals in your corner. So having Lori in mine and my clients is such a huge benefit. I so appreciate her being here. And of course, if you're refinancing, looking for advice, a second opinion on your mortgage, or anything at all mortgage related, feel free to reach out to her. I know you will want Lori in your corner as well.